I can see that there's going to be some very, very big shifts, if you like, in the entire investment scene in 2025. It's very interesting times, I think, very interesting. I mean,
the West is falling behind and the signs are clear. Cheap mining stocks, foreign dumping of treasuries, and skyrocketing interest rates. Are we heading for an economic breaking point? Alasdair Macleod paints a stark picture of 2025, a global shift in investment priorities, rising bond yields, and a U.S. Treasury caught in a dangerous debt trap. Are we witnessing the early days of a financial storm? Stay tuned as we explore Alasdair's analysis and what it means for your wealth in 2025.
No, I think the psychology of it in the West, we are so far behind. We really are. And if you look at the mining sector too, they are. I mean, there are mines which are so incredibly cheap. If you have half an understanding of the potential for the relationship between fiat currencies and gold, and of course, the institutions will switch quite rapidly out of the sort of tech stocks and all the rest of it when that bubble goes, and they'll be walking into trying to find mines. And how many analysts do they have now? I mean, there are very few actually good analysts. I mean, brokers haven't invested in analyzing and covering the mining sector. It's a dirty business and all the rest of it. And anyway, it's been dead for Christ knows how long. Why chuck good money after bad has been the approach. And so I can see that there's going to be some very, very big shifts, if you like, in the entire investment scene in 2025. It's very interesting times, I think, very interesting. I mean, interesting in the sense that, we'll be watching, it's rather like a public execution. You'll be watching people dangling on an end of a rope, sort of speculating how long they're going to be twitching, sort of thinking, hold on, this could happen to me. There's a sort of that sort of feeling, watching these developments. For those of us who have, if you like, an understanding of the relationship between money and credit, this is actually a very, very serious junction. At the margin, it is foreigners who basically will make the price. And we know that China is a net seller. We know that the Japanese are also net sellers. I mean, and that's not a government thing. That's private sector, pension funds, insurance companies, and so on. All the sort of attempts, if you like, to issue long-dated treasuries basically have met with very lukewarm demand. The way in which the US Treasury has been funding itself is essentially through Treasury bills. And so the maturity profile of the debt is shortening and shortening and shortening. And this is actually quite a dangerous situation. I've said this in other interviews. I remember in 1976 when the IMF were called in, when we had a similar debt situation, not nearly as much as we have at the moment, not nearly as bad. But we had a socialist government. Yeah, well, we got another one. We had Dennis Healey, who was going to squeeze the rich until the pips squeak. And the whole situation deteriorated so much that, first of all, the Americans came in and supported sterling because that was threatening to break 1-to-1. And so they bought sterling, squeezed it up, helped it a bit. The quid pro quo was that, one of the American government departments called the IMF were deputed to come in and force the British cabinet into taking action, cutting spending, balancing the books and all the rest of it. And as part of that, I remember gilt issues. There were 3 gilt issues. One of 15% coupon, 15.25, and I particularly remember the 15.5s of 98 because I think I subscribed for those. So now that's what happens when you get the situation we have at the moment. Basically, when you get rising interest rates, when you get rising bond yields, the foreigners aren't going to buy it. If anything, they'll sell it until you raise the rates enough to ensure that they will take a speculative position and buy it. Buy sterling, maybe buy some gilts, whatever. That was the situation back in 76. We have exactly the same dynamics with the US Treasury market today. So, people sort of think, well, they ask me, how high do you see the, bond yields going? Or they think that also the other thing they think is that the Fed's in control of this. It's not. It's not. I mean, they just don't understand that money is like any other commodity. There is a price for it, and that price is called the interest rate. Now, if nobody wants to buy your currency, your credit, then you have to raise the interest rate to the point where they do. And as far as the banks are concerned, they're over-leveraged on their balance sheets. So they're not lending out credit either. So that credit, any expansion of the credit, has to come at a far higher interest rate to reflect the risk which they would be taking on. These interest rates are going to go higher, and I don't care what the Fed does with its interest rate policy. It's going to go higher because they're in a debt trap. And, I wouldn't sort of guarantee that it'll stop at the 15% that we saw in our country back in the 1970s. And think what that does. I mean, it's a situation, this is a point about a debt trap. As the rates go up against you, the situation just gets worse and worse and worse and worse. The Fed, there is only one way in which the Fed can fight this, and that is to replace the lack of buyers for their debt with aggressive quantitative easing. In other words, the Fed becomes the buyer of the entire, Treasury maturity market. Just goes out and buys it, increases its balance sheet. Of course, the other side of that is it floods the economy with cash. What happens to the value of the dollar? It tanks. So, and already, I mean, the Fed is, as I said earlier, I mean, it's already in negative equity from the losses of its previous QE. I mean, the whole point about QE is that you end up, you push interest rates down, you push bond yields down, and then you buy them at the top of the market. That's exactly, that is actually an accurate description of monetary policy. And the losses from the last time round are still there. I mean, well, two points there. I mean, the first one, the real crisis in the UK. Mortgages were very, very restricted in those days for residential property. So generally, I mean, there were people who got harmed badly in the 70s, but not the majority of people because the mortgage exposure was pretty low. But what really happened, I remember this so well, in the latter half of 1973, when the Bank of England raised interest rates that October, it crashed the sort of commercial property market, and it took out the secondary banks. All those sort of Kaiser Ullman, Slater Walker, Vavasor, whatever. All these banks went bust along with property, which became just completely valueless. We've seen a little bit of that this time in America. The commercial real estate market has become pretty unmarketable. And it's hit by two things. First of all, rising interest rates. Now that they've eased off a little bit, there's a sort of slight sigh of relief. But then you've got the working from home.
The debt trap is tightening, and the stakes couldn't be higher. As bond yields rise and the dollar weakens, gold may be the safe haven we all need. Thanks for watching. Don't forget to like, share, and subscribe for more expert insights like this. What's your take on Alasdair's analysis? Let me know in the comments below. Until next time, stay informed and stay prepared.